My name is Brian Shields, and I'm with Mind Property Management. We manage residential rental properties from San Diego, LA, the Bay Area, Sacramento, and Seattle. We're excited to talk to you today about the tax benefits of investing in real estate. Here at Mind Property Management, we like to say we think like investors. Our CEO himself owns 12 buildings that we manage. One of the key components to his success and our clients' success over time is managing the tax liabilities and the tax benefits of your rental properties. So today, we'd like to share a few of the lessons and a few of the best practices that we've seen from our hundreds of clients and our founders' success in investing in real estate and managing their tax liabilities. One example would be being thoughtful about the tax deductions that you can take. Tax deductions in real estate can provide you a lot of benefits. Pretty much all of the expenses associated with a building can be deducted for tax purposes. Why does that matter? Well, if you have a building that brings in $1,000 of rental income, you would need to pay taxes on that whole $1,000 if you didn't have any expenses. But if you believe in the long-term benefit of your building, you may invest in things like new paint or roofing or new windows to keep the heat in. These are all benefits that we see our clients invest in, and ultimately making their properties better, they also create efficient uses of their tax dollars. So instead of having to pay taxes on $1,000 of income, they can now pay taxes on $600 or $700 or $300 of income for that month. Imagine what you could do with an extra couple of $100 a month of saved money back in your pocket. One of the great things that's happened in the last few years is our tax code has been reformed. The exciting part about that is that there are a whole bunch of new opportunities and deductions available for real estate investors. One of the great benefits of real estate is that it's highly tax efficient. One of the new opportunities for real estate owners in 2019 is to take advantage of the qualified income business deduction, also known as Section 199A of the Internal Revenue Code. Now what this means is that 20% of your rental income immediately is tax deductible. So regardless of if you have expenses to allocate against your income, you will receive a 20% deduction out of the gate. So if you're thinking about investing in a property for the first time, or you may just have made some money in previous real estate investments and want to move it to a new investment, know that you have the opportunity to save a lot of money just off of the existing tax code and Section 199A. One question we often get at Mind when managing the properties for our clients is what ways can an owner work with us and other property managers to set themselves up for success when it comes to tax time? The key thing that we continuously remind people about is keeping really good records. That means keeping receipts, organizing what you spent on your building, when you visited the building, and any other investments that you've made for that property. It only works to your benefit to be highly organized around this stuff. The more that you're organized around this data, the better it'll be for you at tax time. Your accountant will love you, and ultimately your bottom line will benefit by having more information for your accountant to work from. One of the things that we focus on at Mind is creating a proprietary system that captures as much information as possible about your building, even down to the unit level. We can work really well with your accountant to provide the data they need to do the taxes. We've found that owners who do this are meticulous, keep great records, and are highly organized tend to save more money on their taxes than people who don't. So we would recommend that you try to be more organized than less, and always ask a property manager how they stay organized about their data. At Mind, we have a lot of clients who ask us about qualified opportunity zones. Now this is another new opportunity provided by the recent tax legislation that allows you, people who invest in rental properties, the opportunity to get creative with managing your taxes. How do they work? Well, qualified opportunity zones are based on one fundamental premise, that investors investing in certain low-income neighborhoods will improve the buildings and make the neighborhood a better place for everybody to live. So what does that mean for you, the investor? Well, you can think a lot about income tax deductions or property tax deductions, but the basic way that this works is if you, the owner, have money that you've made in a different investment, like you sell a stock, you sell another piece of property, etc. Typically, you'd have to pay taxes on that. If you invest it into an opportunity zone, you can then reduce the total amount of taxes you need to pay on the return you got from your last investment. So based on a few rules, you can lower your tax basis by 15%. So if you made $100 on this investment and then invested it into this opportunity zone, you could ultimately only pay taxes on $85. Now that's a huge benefit of investing in real estate. But it doesn't stop there. Opportunity zones also require you to invest and improve the property. Now that's exciting because then you'll have a beautiful building, everybody in the neighborhood will benefit, and you'll ultimately make that place a better place to live. But you also get the benefit of being able to forgive any taxes on capital gains you make from that moment on. So if you took that same $100, invested it into this property, and turned it into $200, you would pay 0 taxes on that additional $100 you just made. Now that's a really exciting part about investing in real estate, and we find that there are many tax opportunities to leverage from investing in properties. A lot of our clients ask us, what are some tax deductions that I haven't thought of? Well, there's the easy stuff like if you don't live in the state that the property exists and you need to fly to it, deduct your travel. Landscaping, different activities requiring with improving the building, showing the building when you have vacancy. These are all things that you can be flexible about doing tax deductions with. But one of the most powerful tools that we've found is something called cost segregation analysis. Now it's a really, really technical analysis, but in short, what it does is take your building, break it apart into different pieces, and look at the depreciation schedule for each of those. Now that's awesome for you because that might mean that you can pull forward some depreciation and in 2019 or 2020, pay more in depreciation expense than you would have normally. So you can shield more of your income up front from taxes and take that money to reinvest it. In some cases, our clients find that they get an extra $10,000 in tax deductible expenses by doing this analysis. That not only pays for the analysis itself, but it also allows you to take extra capital off the table, reinvest it in the property, or allocate it to new investments. So if you want to be really tax efficient by doing something like this, you need to have a lot of data on the property. When was the last time you put in a new tub? What was the model of the old tub? What kind of roof did you put in? All of this kind of information is really important to run this analysis. Now at Mind, we built a system to capture all the detail that you would need to run any kind of tax analysis, including a cost segregation analysis. And we're really, really excited about it because it helps all of our investor clients find more value for their building by just doing taxes a little smarter. And we want to see more people learn about this and implement it at their properties. At Mind Property Management, we love talking to our clients about what is best for their property. Now, of course, we're not tax professionals, but we see a lot of tax advantages by working with our hundreds of clients. We're always happy to share the information and lessons that we've learned by working with these clients, and we're happy to communicate with you and your tax professional about what's best for your property.